Alright, so this is the second part to the IGCSE accounting paper 1 variant 1 from the May-June 2019 session. In this part of the video we'll be completing the paper from questions 4 to 6. So if you missed the previous part, you can go ahead and see that. So question 4. The examiner says the YK Club was formed some years ago. In addition to providing sporting facilities for members, the club also has a shop selling sports clothing. Alright, so their main agenda is providing sporting facilities, but they also have a shop. And then he's given you some shop inventory, opening and closing inventories, and payments for shop supplies, as well as some accruals for shop supplies. And yeah, he asks for the shop income statement. One thing to note here that in these sort of questions, when he doesn't give you revenue directly, he always gives you either a margin or a markup, and that you have to calculate the revenue or sales using the cost of sales, or the gross profit using the markup or the margin. All right. So in this case, he's given you the markup. He says all goods are marked up by 25%. So that means that we uh, they sell they sell all their the goods at 25% above of what they cost the business, right? So that means that the sales are 125% of the cost. All right, so part A, um, prepare the shop income statement for the year ended 31st January 2019. So let's just ignore revenue for now, because first we will need to calculate the cost of sales, right? So we start off by calculating the cost of sales, which is the opening inventory. He's given you that here, 896. So that is 896 opening inventory, and then for purchases, he's given you the total payment during the year, and we're gonna add 470 to it, right? Or actually, let me just explain 420 first. All right, we're gonna subtract 420 from 4150. Why? Because um these $420, these are what we owe to whoever we bought them from last year, right? We owed them last year, and so we pay them off first this year, right? And then we make new purchases, and then we tell them that, hey, I'm gonna pay you next year, or sometime later. So that is going to be accrued for this year. So we subtract 420 from 4150 because we paid that. All right, we paid that already, and we made new purchases of 470 this year. So we add that to the purchases of this year. So that is 4150 minus 420 plus 470. That gives you 4200, the income statement charge for the purchases, right? And then we're just going to, as usual, subtract the closing inventory, which is 960. That gives you cost of sales of 4136. And to calculate the revenue, he's giving you the markup here, 25%. That means that the revenue is 125% of the cost of sales. So we're just going to calculate the 125% of 4136, which gives you $5170, and that is going to be your sales. And we're just going to subtract the cost of sales from the revenue, and that gives us the profit for the shop. All right, 1034. Alright, so part B, he says complete the table to indicate how the following items will be recorded in the financial statements of the YK Club for the year ended 31st January 2019. And blah blah blah. Alright, so he's given you three columns here. He's given you the column for the receipts and payments account, one for the income and expenditure account, and then the balance sheet. So the first point is going to be balance at bank on the 1st of February 2018, and he's written that under the receipts and payments account. So one thing to remember here is that the receipts and payments account is technically your bank, because every cash transaction or bank transaction is going to go through the receipts and payments account, right? So he's given you the balance brought down for the bank over on the receipts and payments accounts. That means that it represents the bank in this case, right? So second point, he's given you already in the question, by the way, right? Insurance paid on 1st of February 2018 for 18 months to 31st July 2019. All right, so he says that we paid on 1st February 2018 for the next 18 months our insurance. So the receipts and payments account being the bank account, we're just going to show a full $1,080 charge there because we paid $1,080, right? We paid it in full. But in the income and expenditure account, we're going to calculate, because in the income statement we only put the charge for the year of anything, any expense or income for that matter, right? We only show whatever we gained or whatever we lost for this year. So because he said here that we paid insurance for 18 months, we only have to calculate the insurance for 12 months, which is 1 year, this year, right? So we're just going to calculate the 1 year charge by multiplying 1080 by uh, multiplied by 12 over 18, right? Which is for 12 months out of 18 months. So that gives us $720. And that is the insurance paid for this year. And then because he says that we paid in advance 6 months, we paid in advance for 6 months. So to calculate the advance payment for 6 months, we're just going to multiply 1080 by 6 over 18. The 6 months out of 18 months of payment. All right, so that gives us $360, and that goes in the balance sheet. Why? Because that becomes a prepaid asset. All right. Okay. So purchase of new sports equipment by check on 31st December 2018. So sports equipment is an asset in this case, and this was made. This was yeah. This transaction is from last year, and he says check. So that means that this must go under the receipts and payments account because it's technically the bank. All right. So 3,500, we bought a new asset. It's already been added to the balance sheet last year, and we just have to put this under the bank. All right. Subscriptions received in January 2019 for the year ending 31st January 2020. All right. So subscriptions again are an asset for the club. All right. So he's saying that subscriptions received in January 2019. All right, so we received them. That means subscriptions are always received in the form of cash. All right, people pay for subscriptions, so that's cash, or in this case, check. So we're just going to put 350 under receipts and payments account because we received $350 worth of money for subscriptions. All right. And then subscriptions are assets, and that's not been added to this year. So we're just going to add that to the balance sheet under our assets. Subscriptions, $350. All right. Next one is accumulated depreciation of sports equipment at 31st January 2018. Right. So he says accumulated depreciation. So we all know that the accumulated depreciation is actually in the balance sheet, and that is subtracted from the cost of whatever asset it is for, and that gives us a the net book value on the balance sheet, right? If it was depreciation charge for the year of sports equipment, then it would be under the income expenditure account because that's depreciation charge, and that has to come in the expenses, right? So cost of goods equipment, cost of sports equipment at 31st January 2019, that is an asset. So that comes in the balance sheet under the non-current assets, all right? Profit from club shop for the year ended 31st January 2019. Yeah, calculated in part A. So that is actually going to be in the income statement. Why? Because it is not the primary agenda of the club, right? The shop is its secondary objective. a secondary source of income. So that will come in the income statement under other incomes. All right. So that is in the income and expenditure account. Bank overdraft on 31st January 2019 worth $1,250. Right. So um, we all know that the bank overdraft is a liability. All right. So that's going to be in the liability section in the balance sheet. Now, because the receipts and payments account again is representing the bank or the cash book in this case, so it's obviously going to affect the bank or the cash book because well, the bank is overdrafted, it's in credit, we owe the bank, so that is going to affect the receipts and payments account as well, $1,250. So that's that. Right, so part C says all right, sorry. Yes, the treasurer is concerned that the overdraft of the YK club is increasing each year. He has recommended that the club should hold fundraising activities to reduce the club's bank overdraft. And then he's asking about two other ways in which the bank overdraft of the club can be reduced. All right, so the first important thing is that to increase subscriptions. Why? Because if we increase the subscriptions, we're going to receive money for them because people will pay for them. So if we receive money, we put it in the bank, the overdraft reduces. Right? Part the second thing you could write is to reduce your overall expenses of the club or the business. This won't necessarily give you money, but it will save you money, and that will over time um, stop the overdraft from increasing, as it says here is increasing each year, right? So that this will counter that. Third, you could write that if you want is to sell surplus assets, meaning if there's any um, is there if there's any useless assets lying around, stuff like that, you can sell that off, receive money, and yeah, that is going to put money in your bank and then reduce the overdraft. All right, so the second point under the additional information uh, heading says that Krishna lives in an apartment above the business premises. 1/4 of the rent and rates relates to Krishna's apartments. This means that the total of the rent and rates, 3/4 of it relates to the business, and 1/4 of it is Krishna's. Krishna's drawing in this case, all right? Because Krishna is using the money of the business for her apartment, right? So she's drawing cash or money from the business to for her personal use, right? So that's a drawing. All right, so we calculated rent rates down here, 7750 plus 1200 minus 550. We're going to multiply that by 3/4, because 3/4 is relating to the business and 1/4 is Krishna's. So that is going to give us 6300. The total of rent and rates uh, without multiplying is actually $8,400, and we multiply that by 3/4, that gives us $6,300. All right, and then for the yes, the depreciation, then uh, he's given you the information here. Point 3. The office fixtures and equipment were valued at 17,320 on 30th April 2019. No office fixture and equipment were purchased or sold during the year. All right, so he's given you the ending value, the ending book value for the year for the office expenses, office fixtures and equipment, right? And he's given you the book value of the office fixtures and equipment at the start of the year. So if he's given you the book values at the start of the year, at the end of the year, so the change in and he's saying that no office fixture and equipment were purchased or sold, then that means that the change in the book values is actually going to be the depreciation charge for the year, right? So that is actually, we can calculate the depreciation by subtracting 17,320 from 18,900, and that's what I've done here. That gives you 1580 worth of depreciation charge for the year for office fixtures and equipment. And then the motor vehicles, he says that they're supposed to be depreciated at 20% per annum using the reducing balance method, right? So it means he's given you the cost and the accumulated depreciation, which he has at cost, and the accumulated depreciation, the provision for depreciation. So we calculate the reducing balance method by subtracting the provision of depreciation from the cost, and then uh, calculating a percentage. So that technically means subtracting 6,300 from 17,500 and then multiplying it by 20%, right? So that gives us 2240. Whoa. All right. So, and then we add the incomes, add the expenses, and subtract the expenses from the incomes, and that gives you a net loss for the year of $100. All right. Part B. So complete the following accounts in Krishna's ledger for the year ended 30th April 2019. Close the accounts by balancing or by making an appropriate year-end transfer. All right, fine. So the first is the drawings account. Remember where the additional information point number 2 said that 1/4 of the rent and rates relates to Krishna's apartment. I told you that this is a drawing because she's technically taking out money from the business for a personal use. So that means that the total of the rent and rates, which was actually $8,400, we calculate 1/4 of that, and that is going to be our drawing, which is $2,100. All right, drawings are debit. You should remember the abbreviation dealer. The D on the left on the debit side actually relates to drawings. All right, so debit drawings account, and as we all know, at the end of the year we have to uh, 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 finish or balance the drawings account. All right, there should be no balance on the drawings account because we don't want any drawings to be carried forward next year. All right, so we're just going to put the drawings under the capital section in the balance sheet by crediting the drawings account as to finish the drawings account, and then subtract the drawings from the capital. You should remember that in the balance sheet that uh, drawings are actually subtracted from the capital or the equity, right? So we're just going to balance this or close this account by uh, transferring the drawings to the capital, subtracting from the capital. All right, so that balances this account. All right, so yeah, next is capital account. So we just I just told you that credit drawings, debit capital. Capital is credit in nature. To increase it, we credit it. But we're subtracting drawings from capital. That means we're drawing the capital account, right? So here it is, drawings 11,250, and we're debiting the capital account because drawings decrease the capital. Now, the income statement 100 is actually the net loss for the year right here. We calculated that in part A. So that is also a debit because it is a net loss. It reduces the capital, right? And then he's given you the balance brought down on the credit side because it's a capital account, which is going to balance this off. The balance carried down is a balancing figure that gives us a total of 38,000, and then the balance brought down for the next year. Don't forget this. This is actually worth a mark, so don't just throw it away. So balance brought down 26,650 for the next year. All right. Next part C. Krishna is considering purchasing business premises costing $80,000. She could invest a further $40,000 as capital. The remaining $40,000 would have to come from a 6% bank loan repayable after 5 years. All right. He's asking, explain 3 factors Krishna should consider when making a decision about purchasing these business premises. All right. So the first thing that she needs to well, obviously that's common sense that when she uh, purchases business premises, then she won't need to pay any more rent, right? So if she doesn't have to pay any more rent, that means that part of her expenses will decrease because now she doesn't have to pay any rent. So that's one thing. But because she's purchasing business premises, she's increasing the area she owns. That means that other expenses will increase. For example, lighting, maintenance, security, cleaning, etc., etc., that is going to increase because other expenses will increase due to uh, the increase in space, technically. All right. And then most important one, I forgot to write it at the top. That is actually going to be if she takes a loan for $40,000, she's going to have to pay $2,400 worth of interest every year because it's a bank loan. All right, so question 6, he says ML Limited was formed some years ago. The company's share capital consists entirely of ordinary shares. And he's asking for us to complete the table. The first one has been completed as an example. So this one is done. We start from this one. He says the amount of issued shares for which payment has been received by the company from shareholders is known as paid up share capital. That is completely correct because share capital is the money we receive by selling shares. All right, that money is called share capital, and that is part of the equity section in the balance sheet, etc., etc. All right, so this is completely true. Next one. He says ordinary shareholders receive a fixed percentage of the profit each year. That is wrong. He's trying to confuse you because ordinary shareholders, their cut of the profit each year may vary. It's the preference shareholders who always receive a fixed percentage of profit. So this becomes false. So, next one. In the event of the company being wound up, the ordinary shares are the last to be repaid. That is right, because firstly, the preference shareholders are paid. That is why their cut of the profit or the dividend or whatever the amount they're owed is fixed. All right, and when they're paid, then ordinary shareholders are paid, and that is why the cut of the profit of the ordinary shareholders is not fixed. It may vary. It may be more than the preference shareholders, maybe less. All right. So that is correct. So ordinary shareholders are personally liable for the debts of the company. That is not true, because no shareholder is personally liable for whatever the company is doing. All right, so that is false. Last one, he says any ordinary share dividend paid during the financial year is entered in the statement of changes of equity, irrespective of the year to which it relates. Yes, because any dividend that we pay should be recorded. Whatever year it's being paid, whether it's interim or it's final, it's been paid, all right? And that it needs to be documented under the dividends paid in the statement of changes of equity, right? So that is true. So down here he's giving you some information, some yeah, ordinary capital and dividends, blah blah blah. Right? Yeah, and he's asking you for to prepare a statement of changes in equity. Right, so on 1st January 2018, he's given you the options for share capital, retained earnings, general reserve, and the total. So this one was small one. So on 1st January 2018, I'm guessing, yeah, that's the year start. That's the year start. So these are brought down values. All right. So let's just copy these. You just have to copy these. All right. So 200,000 for share capital, 16,500 for the retained earnings, 200,000, 16,500, and then 8,000. All right. And then profit for the year. So we're obviously going to have to, yeah, he's given you that here, 28,000. So that the profit for the year obviously is always added into the retained earnings. We know that, all right? So we're just going to add that in the retained earnings account. So that's $28,000, and then dividend paid, final and interim. That is, we pay the dividends. The priority from which we pay the dividends is actually the retained earnings. All right, so we're just going to subtract both 8,000 and 6,000 for final and interim dividends respectively from the retained earnings. That is going to be negative 8,000, and then for interim negative 6,000. All right, And then there's the transfer to general reserve. So he's given you that here, I guess. Yes, on 31st December 2018, it was decided to make a transfer to the General Reserve of $3,000. So that means that, yes, the transfer to the General Reserve is always made from the returned earnings. So we're just going to reduce the returned earnings by 3,000 and then increase the General Reserve by 3,000 because we just took the money from the retained earnings account and then shifted it to the general reserve. All right. So transfer to general reserve, this does not have any effect. We're totaling the columns here. So this is negative 6,000. This is negative 8,000. This is positive 28,000. These three total up to $224,500. All right. And then we total up vertically 200,000. This becomes 27,500. That's positive. All right. This one becomes positive 11,000, and then this one becomes $238,500. All right. So that is that. That one was really straightforward and easy. You should have been able to do that. Part C says calculate the percentage total ordinary share dividend for the year ended 31st December 2018. Right, so that means that we're just going to uh, uh, calculate the percentage for the dividends paid over the total ordinary shares. All right, so how many dividends were paid for how many worth of how much money worth of capital, share capital. All right, so that is going to be, we paid a total of 6,000, which is the interim dividend. All right, for this year, for 31st December 2018. Right, and he's asking for 31st December 2018, so that is going to be 6,000 divided by the share capital at 2018. Sorry, yeah, the same year, which is going to be 200,000. 200,000 into 100. He's asking for the percentage. That gives you 3%. All right, so that's easy. Next he says the directors of ML Limited want to expand the company and need to raise $100,000. They are considering issuing either 6% preference shares or 5% debentures. And then he's asking for three features of preference shares. All right, so obviously we talked about that in, I think, part A. So preference shares, they always have, sorry, I'm just going to write it in short form here, that they have a fixed dividend amount or rate in this case. Amount, rate. All right. So, and second, we can write that preference shareholders, they don't really have any voting rights. All right. Ordinary shareholders do. So no voting rights. And then for the third reason, we can say that their dividends are paid before the ordinary shareholders. That we also talked about up in part A. Dividends paid after ordinary shareholders. Sorry, not after. They're paid before, right? They're paid before the ordinary shareholders. Right. Part E, state three features of debentures. So debentures mostly have loans to them, right? I mean, they are loans, all right? So basically long-term loans in long-term loans. So technically they're long-term loans. That's a feature. And then they have a fixed rate of interest. So you've seen like 5% of whatever amount, 6% of whatever. That's another feature of the debentures. All right, and then because he's talking about the preference shareholders and ordinary shareholders, uh, people mostly confuse that debenture holders are actually don't have any voting rights, or they are not members of the company. All right, they're just the company just owes them. Debenture holders have no voting rights, or not they're not part of the company. All right. So last part, complete the table to indicate the effect of raising funds from an issue of 5% debentures on 1st January 2019. Right, the first one has been completed as an example. Effect on balance at bank, increase of $100,000. All right, so he's implying that we took out a debenture of $100,000 because the bank is increasing by $100,000. So we took a debenture of $100,000 that increases our bank by $100,000, and then our non-current liabilities are also going to increase by $100,000 because we owe the $100,000 to whatever bank or person we took the debenture from, right? And the same goes for working capital because the liabilities increase, and so we have more money to work with. The $100,000 we have as an investment for ourselves, we can invest it somewhere, so that is capital for us. So the working capital increases by $100,000. Now, effect on equity at 1st January 2019. Debentures aren't included in the equity, all right? So that is going to be no effect. And then effect on annual profits, because it has a fixed rate of interest, which is going to calculate the 5% of 100,000, that is going to be 5,000, and that is going to decrease the annual profits by $5,000 each year. All right, so let me just explain this one again. Effect on equity at 1st January 2019. So the debentures are actually liabilities, they're not included in the equity. But why do I say that it's included in the working capital? Because working capital is not included in the balance sheet. It just signifies the amount of money we have to invest, to do projects, to spend for the business technically.